Hey guys, it's Jamin Coker with Secure Financial Management. Want to get a quick video out to you on a few thoughts that we have right now about everything that's going on and really answer some questions that we're getting from clients a lot right now. If our clients are asking questions like that, probably you have those same questions as well. And if we can help you out with getting answers to those, we always love to do that. And so the first thing I want to take a sidestep from our main conversation that I want to have with you and talk about systematic risk. You've heard me talk about systematic and unsystematic risk and building portfolios and try to diversify, and some of the risk you can diversify away from, some of it you can't. The risk that you can't diversify away from we call systematic risk. And the reason I'm mentioning that right now is that I give you guys examples of that, right? But recently we had a real life example of systematic risk, and when I can get a real life example that I share with you, it just seems to highlight the risk type a little bit more, right? And that's recently what happened in Saudi Arabia. Just I think it was just the weekend, Saturday or Sunday, there was some sort of drone attack on one of their facilities. I believe it was a refining facility that they had there. Who knew that was going to happen, right? A few days before that, who knew that there was going to be a drone strike a facility that most of us probably didn't even know about in Saudi Arabia? And we couldn't prepare for it. Right, we didn't know what was going to happen, that was going to happen, we couldn't prepare for it, and that's part of systematic risk. Now it turns out that didn't have that much of an effect on the markets. Yes, the markets were down yesterday slightly, oil was up big time, that's already starting to come in a little bit today, but a great example of systematic risk, and that investing has inherent risk to it that you can't always diversify away from, regardless of how your portfolio is built. So when I can get a real life example of that, I like to share it with you because I think that just highlights what we talk about a little bit more. Okay, next I want to talk a little bit about market volatility. So we haven't had much in the last maybe 10 days to 2 weeks, which is nice. It's nice to get a little bit of a break from that. But more in the effect of the conversation we have a lot with clients is, man, it seems like the markets move around and are a lot more volatile now than they used to be. You know, when I was in my prime working years in the 90s or early 2000s or wherever that might have been, yeah, the markets moved around, but it didn't seem to be to the degree that they do now. And part of that, I think, is that when you look back and as humans, when we reflect, I think we tend to reflect, most of us at least tend to reflect more on kind of the positive things and remembering the good stuff and trying to forget the bad stuff. But part of it is because that's true, right? The markets are more volatile now than they used to be. And an example of how I can highlight that is back in the 90s, I don't know when they ended this process, maybe it was in the 90s or early 2000s, but the wire houses, when we call wire houses, think of like the brokerage houses, Merrill Lynch, things like that, they used to have what's called a 1% letter. And that 1% letter was kind of like a form letter that they already had, that when the markets moved more than 1%, they'd send it out to clients, and they'd customize a little bit with whatever's going on at that moment. But they'd send that 1% letter out to clients, and it's a good tool to kind of help calm nerves, you know, build relationships, stuff like that. And that letter might go out a couple of times a year, maybe 3 or 4 times a year. Well, they don't do that anymore, right? And they don't do it because you'd be doing it 2 or 3 times a month rather than 2 or 3 times a year, the way that the market moves around now. So part of why you feel it's crazier than it used to be is because it is. And part of the reason it is that often it's not humans doing the trading. It's not me, it's not other colleagues that are in this industry, it's not individual stockbrokers, it's machines and algorithms that are trading. I read recently in The Economist that when we have those really big days, those down 800 point days that we hate having, right? When those days are happening, up to 90% of the trading is not being done by individuals, by humans. It's being done by algorithms, by machines that read headlines, and once the market passes its 50-day average, it sells off, and then once it passes its 200-day average, it sells off more. It's machines that are trading on just pure data, no emotions, and they can trade a lot quicker than any of us can. And so when we see those big volatile days, and you think, oh, it feels like this didn't used to happen as much, you're right, it didn't. And I wish this wasn't the case, what I'm about to say, but from all I can see is that is the new normal, right? Most industries are moving to forms of automation, including ours, and I can't see that changing anytime soon. So it looks like that volatility, those extreme moves, are trending to be the new normal. Okay, so kind of tying into that topic we just talked about, we haven't had much volatility in the last 10 days to 2 weeks, right? What's that all about? China trade's part of it. I'm sick of talking about China trade. You're probably sick about hearing about it as well. They look like they're starting to work together a little bit more, the US and China. That's helped calm nerves. Who knows if it's real? Seems like the 5th, 6th, 7th, maybe 10th time we've gone down that road. So who knows about that? I think the big thing right now is that we have a Fed meeting. The Fed is meeting today and tomorrow. And the markets are waiting to see what direction that they go, right? Are they going to cut rates? If they do, is that going to be the trend going forward? Are they going to set that expectation? Are they going to maintain where they are? That is the biggest thing that's on the market's mind right now, and why we don't have a lot of movement up and down. Any movement that we see in the next several days very likely will be tied to that decision. We'll be watching it closely and encourage you to as well. Hope that information's helped out, guys. As always, nothing that we discussed here should be taken as an investment recommendation. If you have any questions, please give us a call at the office, 210-428-6250. We'd love to speak with you.